value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about Unity software. So Unity is quite an interesting business model. It's really very large in the gaming industry, and it's kind of growing at a reasonable rate. It's growing at about 30% compounded annual growth rates, and we're going to just kind of go through what's compelling about here, what's the one thing that really detracts me from getting involved, and then we're going to bring this all together and talk about its valuation. So just to kick it off, so the idea behind Unity is that it allows you as the user to interact at the metaverse. This is the space between the digital and the real world. So it's kind of a lot of augmented reality or virtual reality. It's the ability to just be at that cross section, and it allows the creator to put out their content across any device. So it's a low-code software, and it really pushes you to be much more interactive and feel immersed inside the technology. So one of the things that I find quite interesting here is that Unity is very much that path that we've seen in many of these high growth names that are unprofitable. Coming into February, the stock was growing very, very strongly, and then since February 21 into May, we see that deceleration. And then since May, we've seen that the market started to be more discerning. This is something that I've been stating, if you've been listening to me for a while, that since really approximately July, the market's been quite discerning what's worthwhile getting invested in and what's worthwhile just dumping. So I think that now, if coming in to 2021 into February, everything was just like, all these baskets of high growth and profitable names were just flying higher. Now the market is quite more discerning and picking out certain opportunities. So this is something that I'd actually noted back in July, that I'd said that Unity was one of those companies that if investors were willing to really get involved and do a little bit of work, they could see that there was an opportunity for the stock to be picked up, because this is a company that has been consistently saying to its investors that we have what it takes to grow at a 30% compound annual growth rate. And when they put out their guidance for Q2, previously they were estimating to grow at approximately 33% year over year. When the actual results came out, they actually grew at 48% year over year. So they're growing really, really fast. And when they just slightly up their guidance for the rest of the year, investors are like, yeah, probably you're being quite conservative, and there's reasons for us to kind of get bullish, because the stock has kind of come down slightly in the valuation. And since you've been able to so consistently put out strong growth rates, and you can see here, going back several quarters, we can see the company is kind of growing at closer to 40% over the past 4 quarters. So I think if we go back even further, I think for approximately 12 quarters, they've been growing at 30%. So they feel quite bullish enough to put out the guidance and say, we have what it takes to grow at 30%. The one thing that I'm kind of detracted about the company is that the company is going to this year is going to come in and they're guiding for negative 5% operating margins. Now that's not really that attractive if you remember that this is a non-GAAP metric where everything else is added back. On the other side of the equation, do remember that coming out of 2020, the guidance for the year at the end of Q4 was for a non-GAAP operating margin to be at negative 10% at the midpoint. So halfway through the year, they've been able to not only increase the top line guidance, but actually say that we're going to be meaningfully less unprofitable. That's quite a catch-all. We're going to be at closer to negative 5% versus negative 10% that we were estimating early on in the year. So it shows that over time, they are starting to very slowly cut into being break-even. Keep in mind they've got $1 billion of cash on the balance sheet, so they've got plenty of room here to keep investing for growth. The stock is not particularly cheap, right? So they're paying 27 times next year's sales for something that's growing approximately 30% compound annual growth rate. It's not something that is like dirty cheap, but there again, if you look at Unity, it hasn't really ever been dirty cheap, and many of these names in this space of developing or operations, they have been quite expensive. So one example that I want to put out there is Atlassian. So Atlassian is priced at approximately 40 times this year's. Their fiscal year finishes in July next year, but they're priced at 40 times forward sales, and they only estimated to grow at approximately 25%. So in that light, it appears that, yeah, okay, Unity is not that expensive. In any case, I do find for now there are better investment opportunities out there. Yes, so I think that that paying this kind of multiple is okay, but you can do better. So don't forget to check out my marketplace, Deep Value Returns. You're welcome to do a totally free trial, and you can see which stocks I'm investing in right now that I find particularly attractive. And you can unsubscribe anytime before the 14 days. And if you like it, you stick around. But if you don't like it, you unsubscribe. You're not going to get charged anything at all. So anyway, I hope to see you soon. Bye bye.